All right, we got a little over a minute to go before we get started. Welcome more forward to the chat. Happy to see you, and thank you for bearing with me as I work through what seems to be so many technical issues lately as I try to get this stream online. But hopefully Lenovo will get their act together and send that laptop back to me at some point soon, and we'll be good to go. But until now, what we got is what we got. All right, now we got about 30 seconds to go. And welcome, Sierra. I'm glad we've got the gang is all here. If anyone else is out there, feel free to check in the chat. I would be happy to give you a shout out to give you some recognition for joining us on a Sunday night. And there's Jules in the YouTube chat. We've got everyone. All right. So that is the timer. Let me X out of that. And we kick it off the way that we always do with the recap of what happened to us last week. And we don't try to hide anything here. We got absolutely crushed last week in the market. And the biggest contributors to that were the performance of Zillow and Etsy. As you can see here, we lost about $6,000 on Etsy and a little over $2,000 on Zillow. LOTZ was one that took a nosedive as well. We lost a little over $1,000 there. And we took another pretty big hit when UWMC went from, it's crazy to look back at this now and see that UWMC started the week at 816. But they did, and they went all the way down below $7 a share, which, killed the shares. It killed the 9-strike puts that we sold, so we lost a decent amount on that as well. All in all, we lost about $14K overall on the week, but again, not something we're going to try to hide. If we look at that in the context of our performance on the year, over the last 3 weeks, we're still positive despite having our worst single week yet in 2021 by a decent margin. And, what happened with us, with Zillow, it dropped a ton. We had a hypothesis that they would beat on earnings, and what's unfortunate is that they did beat on earnings, but still went down anyways, so that one didn't really help us out too much. So that was unfortunate. Etsy also beat on earnings and dropped about 25 to 30%, I think, on us, which is just terrible luck. But, as always on this channel, the good news is that we could save these plays. As you could see, for the plays that we had set up next week, we've already made back about $4,000 right there, and hopefully can cut a little bit further into that as we progress towards mid-May coming up here soon. I still haven't filled out the profit spreadsheet to fully account for what happened last week and set everything up for next week, but this is roughly the damage that we had, and we should be able to recover a decent amount of it next week. I think the goal at this point for us, looking up and saying, hey, first week in May we lost $14,000. I think a good goal for us between now and the end of May is just to get back to break even. We had an awesome April making $18,000. March was solid too. We can never get mad at making $6,000. February was relatively flat. And January, 14.6K, we got off to an awesome start that year. We got off to an awesome start on the year, so that was great. But it's one of those things where, hey, we take this on a week-to-week basis, and a week-to-week basis turns into a month-to-month basis. So eventually we will be back. It's just never fun to have a straight nosedive on your account balance for the year, but all things considered, still really profitable. We're up 30% on the year, which is outperforming the S&P 500 index, which is all that we try to do. And if we include what we've made for our positions that we have set up next week, we'd be right back above here somewhere in the 35% return range. So we rolled our plays over. We're going to let them ride, and we'll get into more detail about what we did to manage those plays individually as we move forward here on the stream. But that's just a quick overview, profit and loss wise, of what happened to us. Again, one of those things that's never fun to lose this much money in a month, but I feel so many times on social media, you're only going to see people telling you, hey, oh, we made a bunch of money this week. Oh, we killed it this week. We killed this trade. We won this trade. We won this trade. The reality of trading is that's not going to happen to you every single week. And while we have, looking back, had a decent stretch of weeks and have had a great 2021 overall, there always is that lurking reality that you're not going to be green 52 weeks out of the year. That's just not how it works. The important part is being able to manage these losses and put yourself in a position where you could come back from a big drop like we saw last week. So let's talk about what happened last week and how we plan to get back from it. UWMC, that plan is always going to be, that is what it's been. We look at the trade breakout tab, kind of is what it is. We got a 645 break even price here, I think. So sucks that we're losing a little bit on the 9-strike puts that we sold, but again, these 9-strike calls presumably are going to finish worthless, which we're going to collect a decent amount on that. And again, this is when we started playing at $10.84, and our break-even price is $6.45, so that's incredible. Obviously not the greatest return overall when we look at what we've made on this play and what our annualized return is, but when we're making money on a play where the stock has dropped 36% on us, we can never be too mad at that. So we're just going to keep on moving forward with our process and our strategy the way it works on this one. They have earnings coming up, I think, this next week here. So hopefully we could see some really strong numbers, maybe bounce back up to the $8 range and recover these losses. Because, I mean, we lost, looks like the Google finance formula just completely went against us right there. So we're going to have some NAs here, which is kind of annoying. But we know that this was a loss. And if we get back up to 8 here, we're going to be able to recover pretty much all that loss. So that's one we're not terribly worried about. PSTH, we had to trim that position a little bit because we needed some buying power freed up. But again, not one we're terribly worried about. We're going to hang tight, keep selling week-to-week covered calls. And we did originally sell the 27 strike covered calls expiring May 21st on that one. LOTZ 7.5 strike puts. This was another one that kind of came out of nowhere and really was a little bit of a dagger there for us because we had this one, I think, trading above 750 at the start of the week, and we could pull up the charts to double check what I'm telling you right here if we put in LOTZ. There we go. We'll bring you the 5-day chart right here. Yes, the beginning of the week it was trading up at about $7.60 more for. I really do apologize for having to trim my PSTH position. I'm always a big fan of the PSTH gang. I think good things are coming. I think great things are coming for them. But unfortunately, some very bad things were coming for my portfolio, so I had to cut ties with some of my positions. And that was that one was at the top of the list, so I could free up buying power, not have to completely liquidate all my positions there. But I'll be back in if I get some more buying power. Don't you worry. There's plenty of hope ahead for PSTH gang. But going back to what we were talking about with LOTZ, it started above 750, which, as we know, when we sell 7.5 strike puts, that's our max profit level. So we were in a position where, hey, as long as LOTZ trades flat between now and May 21st, we're hitting max profit. Great, but obviously, as we can see, that is not what happened. It dropped all the way down to 6.66, kind of scary there, but came back up to roughly 7.17 after hours trading on Friday. So what do we know about a stock that has, about an option that we sell at 7.5? If it's trading, the underlying is 7.17. That means it's going to be in the money by 30 cents, which means that that option is going to be worth 30 cents at expiry. So if we go down here to what we have set up for next week, we'll be able to see that, look, this is going to be worth 30 cents at expiry, just if this trades flat over the next 2 weeks. And we'll recover $2,500 off that position just if it stays where it is at 720. And that is why we're comfortable that even though we lost $1,300 on it last week from that price action, as long as it just hangs tight at 720, doesn't go any lower, it could even go up, we'll make more money. But if it stays flat between now and May 21st, we're going to recover $2,500. So that's why we've got some peace of mind regarding this loss right here. The next one on there is Icln. That one's kind of a pain in the ass because it is not moving that much. The premium sucks and has just completely gone down the whole time. But one of those where it's not really a huge position buying power wise. So we're just going to let it sit at the bottom of our portfolio and hopefully collect some cash on that. Let me try to refresh this tab to see if this fixes these NAs right here, because this is kind of a little bit annoying to follow along with, I'm sure, when you're seeing all these NAs and I'm trying to talk numbers on these positions. So as you can see, my computer lightning speed refreshing this this profit tracker page. Hopefully it'll load here for me. Please don't be NAs. Okay, we are back. And what I should do right now is copy these and paste the values so that doesn't happen again. So now that we've got some actual numbers we can look at, STON, that one has been awesome for us. We talked about that one a few weeks ago where it was on the brink of death. We were going to cut ties with it, but it ran all the way back up to 267, and it's now in max profit territory. I do need to update this, though, because these calls are trading for 40 cents a piece now. 0.4. So our loss is actually much worse than it looks. 15K now, as we are live updating our weekly profit results here. Either way, not a great week, but that's all right because we have some recourse. NNDM has dropped not significantly since we opened it because we got in. We could take a look at our trade breakout tab again. We got in at 662. It's up to 667, so technically it's increased. And we'd be sitting on a 9.6% return in just over a month, which annualizes to 171% just if it stays flat. So not too bad, but again, one of those where if we go over to the chart and pull up NNDM, we will see that it was trading much, much higher. Not only 5 days ago, but if we pull up the whole month, it got up to about 950 one morning. We thought we were going to be cruising to max profit at the 750 level. But, you know, stocks are volatile. They go up, they go down, especially some of these names that we like to sell premium on. So that's just part of the game. If it stays below 750, I'm perfectly happy to jump back into the options chain. Take a look at what's going on for June. Sell 750 strike calls again for maybe 60 more cents. I don't think that's bad value at all right there. What might be even better is these 5-strike puts now look like they might have a bit of premium. But that's because those are, you know, a month and 2 weeks out. So there's a lot of time left on those. That might not be the situation. We see once our original play of 7.5 strike covered calls matures in a couple weeks. But again, one of those where, and this is going to be, you know, common advice to most of the plays that we run. We're going to let these expire worthless, collect that free $765. If the shares go back up to 750, we'll make a bunch more money on the shares and walk away with max profit on the trade. But if not, we're perfectly happy to sell more covered calls at the 7.5 strike for June expiry. Moving down the list, RMO. This is another one that kind of killed us a bit because we lost a decent amount on the 9-strike puts that we sold. And these calls are going to expire worthless. Or I hope they don't expire worthless because that means our shares would go back up and we'd make max profit on these puts we sold. But again, another one of those where it's trading at 772, which is almost $1 decrease from what it started the week at. So obviously, if we've got a bullish position on that, it's not going to turn out too great. All in all, we lost about $2,000 on that one. But again, one that we've got set up, and we're going to let it ride into the following week. All of these positions expire on May 21st. So here's the deal: if it, you know, goes up to, or even let's just say it stays where it is at 772, we know those are going to expire worthless, and these are going to finish at about $1.28 here. So between now and then, if it stays flat, we're recovering $1,000 right there. And that is, you know, perfectly fine with me. If this thing wants to go back up to $9, these are going to expire worthless, and we're going to make $7,500 on those. So this is I like this one because, you know, it sucks that we lost on a week-to-week basis, but the amount of premium we're collecting here puts us in a position where, okay, we could either have it trade flat and make back $1,000 right here, or we've got some upside where if it runs up to 9, we're going to make $7,500, which is a huge number. And again, those are reasons why I'm not terribly concerned about what's going on a week-to-week basis if we lose over a 5-day period, because in the bigger picture, we've got some more premium to collect. We've got a little bit more cushion on the downside relative to where it's currently trading. And if we get a little bump between now and May 21st, that's going to look really nice in our profit and loss for the period. So moving further down, now we're going to get into the earnings plays that we alluded to a little bit at the beginning of the stream. So Etsy, we sold 180 strike puts on Etsy. And let me just pull the chart up on this one so we can narrate what's been going on. Yeah, so as you can see on the 1-month chart, it was previously trading at about $227. Ended up dropping on April 20th right around here. And we, I think, sold 1-week puts for these right around 205 that we made some money on. And then once those expired, it was back at that 205 level. And we said, hey, we really liked the premium that these gave us the first time. Let's see what kind of premium we get now. And we saw the fact that, look, saw what we could see up to this point in time. You know, 180 looks like a pretty good base. If we zoom out on the y-axis here, we could set up a trade where as long as Etsy stayed above this level right here, which looking at this graph seems like a pretty damn big drop, we'd hit max profit and a really nice return. And I could show you, yeah, the week before here, we made a quick $440 on this 205 strike put. So we were feeling good about Etsy. We just made some money on it. We were happy to go back in on it with the 180 strike puts. But, as I'm sure you probably know at this point, we can go back to the 10-day or something here. It dropped from, 215 down to 154 at the low point, which is like a 30% drop on the stock. And, you're just never going to survive a 30% drop the week of. Now we could put ourselves in a position where we can make some money back and, find ourselves potentially in a profitable position overall on Etsy. And I think that's exactly what we did. So keeping in mind that this thing dropped 30% on us and we had a bullish play on it, here is how we managed that one. So let's go to the Etsy trade breakout. What we did immediately was we first rolled these down and out. We closed some of them off the bat for $4.99, and then we had to close the rest of them for $20.99. So that's an average closing price of $14.59, which represents a $6,000 loss on our original position. Objectively, that sucks. We're not happy about that. But then what we did was we sold some 165 strike puts that also expired on 5/7. We did this all on Friday, by the way. We did it right around here. We said, hey, it's been beaten up pretty badly over the last couple days due to this earnings dip. We're going to sell a 165 strike put, try to take advantage of the volatility and hopefully catch a little bit of a bounce. And we were able to do that. I think we're able to close out of this Etsy. Let me take a look at the trades to see what we were actually able to close out of it at, and I could put that in there. Yeah, we closed out of these for $1.50. Now, they would have hit max profit because Etsy finished above 165. So that is a little bit annoying. But we were able to close these out for $1.50 a piece, which means we made $880 that day. And that's not a lot compared to a $6,000 loss off the first leg, but it's about taking these things, one little step at a time. Able to close these out for $1.50 a piece, collect that $880 on Friday, and then since we rolled these over and out to May 14th in a lower strike, 170 for a 12.4 credit, we're in a position now where if these expire worthless, we're now in a profit overall on the trade. So we could put ourselves in a position essentially where if Etsy gets to 170 by next Friday, and if we look here, that's just right here. That's not that big of a recovery off a drop that came from 215. So in plain English, when we summarize this trade, we would have put ourselves in a position where, hey, we had a bullish position on Etsy. It dropped 16% on us, but we were still able to make money on the trade. And if we could play these big names like this and be able to absorb a 16% loss while still coming out with enough profit to represent a 6.86% return in just a couple weeks, which annualizes to almost 500% on the year, that is some incredible value, and why when we're able to identify good setups like this, where these bigger stocks offer some really nice option premiums, we're going to put ourselves in some really high probability trades and find ourselves stacking gain after gain after gain. And while sometimes it's not going to look great because they could drop against us in a hurry like we saw here, and we might see some big losses on a week-to-week basis, it's important to trust that what we're doing is putting ourselves in these high probability positions, and eventually in the long run, we're going to be seeing this motion up and to the right on our account balance chart. While it might look a little bit like a heart attack on the way up there, the general long-term trend that we're going to see is up and to the right, because what we're doing right here, and as we can see on the Etsy trade breakout tab that we have, we're just continually lowering our break-even price. And while Etsy might not be able to go down forever, I mean, no stock goes down forever. Even stocks that go bankrupt have little bounces and green weeks here and there. So that's something where we'd be helped out big time if Etsy was green this week. But we're in a position where, hey, we started off when the stock was at $203.50. That's the initial stock price. When we sold these 180 strike puts, our break-even price was $177.50, which alone was a pretty damn big cushion, quite frankly. But after that, everything we did on May 6th to roll these plays now has us at a 167.5 break-even price, meaning that in just 2 short weeks, and really just over 1 week since we opened the play, we have reduced our break-even price by 17.69%. And if we could do that on a consistent basis, stocks aren't going to all drop 17.69% week after week after week. That's just not something that's going to happen. So we're eventually going to come out on top. Now, whether it's this week or 3 weeks or 4 weeks or 5 weeks from now, once we keep dropping this break-even price and it hopefully catches up with what the stock price is, we're gonna eventually come out on top, unless of course something crazy happens and Etsy loses 50% of its value next week. But again, when you play bigger stocks like this, you could back up and see that's probably not going to happen. And we waited because Etsy, if you go even further back, was all the way up to 250 pretty recently. So relatively, this looked like a decent entry. There was some support in the 195 range, which we saw. But there's some additional support here in this 168. It looks like 170 range. So hopefully we can pull back up to that level over the next week, and the play will be saved. But if not, there could be some more support at the 150 level. Looking at what we see right here, the peak that we see from back in mid-October of 2020, and that's at that 150 level. And if you extend this line across, you could look at the price and see that it bounced pretty cleanly off that 155 level. So we're hoping we could see a return up to 170 just so we could break even on the trade. And if we are in a trade, and again, I might sound like a little bit of a broken record when I say stuff like this, but the fact that this dropped so quickly against us, yet we're still in a position where we could come out on top, says so much about the strategy that we're running here on this channel with everyone in our group, and why in the long run we are going to be okay, we're going to be profitable, and we are going to put ourselves in a position where hopefully we're outperforming the market thanks to the increased levels of premium and opportunities like this that we identify. So they're not all going to go our way against the bat or off the bat. And as we can see historically, this is a pretty damn big red candle. You can only see maybe 2 instances of one that big in the last 180 days. So quite frankly, it was just pretty shitty luck on our part. But it happens. The market is not always going to go in your favor. You have to be prepared for when stuff like this happens. And hopefully what we've set up here demonstrates how we prepare for when something like that happens. So let me put this formula back in here, and we'll get the Etsy live price of 165.51. We're going to redo the formula here. 170 minus the current price to give us what the debit to close would be if it expired today, and that's 449. So we're at a position right now, even if Etsy just stays where it is this next week, we're only down $1,200 on a trade where off the bat we lost $6,000, and that's a pretty quick turnaround. And that would again be a position where Etsy has dropped 18% against us. So we're just going to keep sticking with that one. And moving on to the next one that we had was the Zillow trade. So this was another one. I have a little bit of regret on this one because I feel like the advice I always give others and myself when I'm in positions like this is to just hold on tight to the stock, or not to the stock, but to the options we sold. Because when we sell options, the options expire, but we could keep rolling forward like we saw with Etsy, and we could keep waiting up until expiry, because as we've seen with most of these plays, if a stock stays flat between now and expiry, we're going to make more money than we have right now. So we have the luxury of waiting as option sellers, as opposed to when people are buying options. I'm sure those of you who have purchased options have been in the situation where you might have purchased a call or something. The stock was trading flat and your option is decreasing in value. When you're buying options, that makes the decision about whether or not to hold or sell a lot more difficult. Whereas when we're selling options, the price of the option decreases, which means we're making money. So we have the luxury of being able to sit around and wait until expiry. And that is something that I wish I did, because let me pull up the Zillow chart right here and narrate what was going on throughout the week for us. So again, this is one of those that we saw shot up a ton back in mid-February to 208. So we were thrilled about an entry anywhere in this 120 to 130 level, because we see that the stock bottoms out here, bottoms out here, bottoms out here, and these are all in the mid 120 range. So we thought there'd be a decent level of support. But as is the story for us last week with how earnings went, it just completely tanked. And the worst part about this one tanking isn't the fact that it went down, but it's the brief glimmer of hope that the stock gave us when after hours we thought that Zillow was going to beat earnings. They released an awesome earnings report, and it ran up to about $128 a share. So when after hours trading finished up that night, we thought we were going to go to bed with a huge victory that week and pull max profit on the trade, which, flipping back to our profit tracker, would have been a 1890 gain. So we thought we were going to make about $2,000 on something that was relatively easy money. Unfortunately, there is no such thing as easy money in the market, and if there's any lesson we can impart upon you as we review what happened to us last week, I think this would be it. But it dropped pretty sharply after being up, so we went from thinking we were going to have an easy win, and again, our max profit level was 120 because we sold 120 strike puts. It dipped pretty severely below that, and it got to the point where, at 108.29 on Thursday morning, we said, okay, it's time to manage this position, roll these things down and out. Now, as you can see from the chart, it ran back up to 118.75, which means that the puts we sold would have been worth $1.25 at expiry. So if we just didn't do anything, we would have had a $1,000 gain. But what we did was we closed these out for a loss. We closed half, as you can see here, for $3.40, the other half for $10.56, for an average of almost $7 debit, which led to a $2,300 loss off the bat on that first leg. So what do? The first thing is we roll our original position down and out. So we rolled down to 110 strike, meaning we're more likely to hit max profit here because our max profit target is $10 lower. And we rolled them out. Our original expiry was May 7th. We rolled these out to May 14th. We were able to get a $4.20 premium on those, which alone means that as long as Zillow finished above 110 bucks and these expired worthless, we were going to make $2,500 on this leg, meaning overall in the position that we would make $222, putting us at a gain despite the fact that the stock dropped over 10% on us. And that is a common theme with these that we're talking about that we have to quote unquote rescue, because we're still able to put ourselves in positions where we see some pretty big moves against us from the underlying that we were playing. But what we also did, because I like Zillow so much, and when we what we did talk about when we first looked at this chart was the fact that, hey, a lot of good support in this range, was recently at 200 bucks. I think this is a great entry on a great stock. We added a little bit more of a position, so we sold even more at 115. This was after a bounce, as you can see, because typically you'd get a lot more premium on 115 than you would at 110. But I waited for a little bit of a bounce, sold the 115 for 427, so similar premiums, but are now again at the point where if it finishes above 115, which it currently is, we'll collect another 800 bucks on that. And by May 14th, next Friday, what could happen to us if Zillow finishes above 115, and again, it's at 118 right now, so as long as it just stays flat, goes up, or doesn't go down more than $3, we're in a position where we're going to make $1,000 on the trade in 2 weeks, which is going to represent a 9.62% return on capital, which is almost 1,000% annualized. And we did it on a stock that went down 9.16% against us. And we got NeoTF checking into the YouTube chat, letting us know he's watching our videos. I love it when you guys are watching the videos. Again, he's on part 3. We got, I think, 4 parts of the HT wheel, which is essentially the strategy that we've laid out here and are talking about tonight. But again, if any of you guys are going through those videos, have any questions, feel free to leave a comment on the videos, come into our Discord server, ask us questions. Either I or several other of the helpful members of our Discord server, I'm sure, would be happy to help you. Because the great part about the strategy is, look, I'm not selling options to you. We could all sell options together, and we could all win together as a group. It doesn't cost me a single dollar to let you in on a similar position if we all talk about our trade ideas and make money together. Now, if you were following us last week, you probably didn't make money, but the idea, as we've laid out here and displayed with some of these setups that we have for these earning plays, is that eventually we will make money, and hopefully it will be together, so we can all eventually live on a private island somewhere, thanks to these option selling strategies that we have employed. But that is the roundup of the 2 main earnings plays that we ran last week between Etsy and Zillow. So it is discouraging a little bit when you run earnings plays on 2 stocks, both stocks beat earnings, and then both stocks have this insane, 18.67 and 9.16% drop on you. That's never fun, and it can be discouraging. But hopefully you can see the value in, the amount of premium that this offers lets us continually lower this break-even price. And in 6 days, the time between April 30th and May 6th, we went from Zillow being at $130.50 a share, and we now have a break-even price of $109.90, which is a 15.79% reduction. Again, meaning that as long as Zillow didn't drop 15.79% in 2 weeks, which is a big move, we were going to make money. And even if it does keep dropping, we could roll these down, roll these out, potentially add even more, and we're going to be good to go. And thank you. Shout out to KB in the YouTube comments letting us know he loves the videos and the content. We always appreciate the viewers of the content and the people who are joining us on the live stream, so appreciate you checking in with us tonight. Going back to our weekly profit tracker, you might need some bleach for your eyes on this one as we pull back up this huge red number. Let's talk a little bit about Twitter really quickly, because that was another quick non-earnings related play. I could pop up the chart right here really quickly, TWTR. We've got a question about Peloton. Doesn't understand our strategy was. Took 4 contracts. I do remember that. I do remember that. We will talk about that right after this one. So we'll get into the Peloton play right after what we did with Twitter. Twitter was one we got in after earnings, right? Because Twitter, I mean, relatively decent tech stock. Whether or not you think their business is viable long term based off user base, based off, the amount of ad revenue they're generating, that's a different discussion. But one of those things where I thought, off recent highs of 81 back at the beginning of March, a huge drop from 68 to 55, I figured that would at least be recovered by something like this. And again, what we like to look at when we try to pick strikes to sell for options is where we could expect to see a little bit of support. And what I looked at was in this mid-December, mid-January window where it was trading in a range of about, 53 to $55. And that's a pretty tight range for that long of a period of time. So I'd imagine that even though there was a big drop from 70 down to 55, it would take a little bit more to get it down below this price level right here. So that's what we decided to do off the bat. We wanted to sell 55 strike puts for Twitter, and we could pop over to that trade breakout tab and talk about how this one played out. And once again, the Google Finance formula is not working. So we're going to refresh this again and hope it finally starts working. And this again is one that I did not update yet. So you guys are going to have the pleasure of seeing me update this one live with the prices. Okay, well, that's a pain because it's not updating here. But what we did on this one, as I said, I thought 55 was a decent level. We were able to sell these for a 95-cent credit, which means off the bat, our break-even price was going to be that 55 strike minus 95 cents for a $54.05 break-even price. And we got in on this one at $57. So we thought, hey, if it bounces from 57, perfectly happy. But if not, we like that support that we presumably see at that 55 strike level. So we sold it for 95 cents a piece. It dropped below 54.05. So we're initially at a loss. We were actually able to close these out for $1.36 a piece, which put us, if this will hurry up and recalculate, go, put us at a $410 loss off the bat on this one. Which, not the worst thing in the world. We're going to update this end date to 5/14/21 while we're at it. It's a minus 3.7% return, but hey, the stock dropped 5.6%. So we're at least saving ourselves a little bit of money compared to if we had just jumped in on the stock. And that's what this strategy is all about. So what we then did was we like to talk about rolling down. We'd like to talk about rolling out. So we rolled them out in the sense that we sold Twitter 5/14 expiry, and we rolled them down because we chose a 54 strike. And we were able to sell these for $1.31 a piece. And we're going to drag that formula down, meaning that as long as Twitter finishes above $54 now, we're going to finish with a profit overall on the trade. Because our first leg, we lost 410, but this new leg, selling 10 of these at $1.31 credit, is going to give us $1,300 of profit for a net profit of $900 over a 2-week period, which, pretty decent return. The buying power required for this trade for us was only about 11 grand. So I'm perfectly happy with, not perfectly happy. I'd be thrilled with the 8.14% return in a 2-week period because that annualizes to over 660%. And this is what we want to try to pay attention to because sometimes it's easy to get impatient and unhappy with gains where you say, okay, I only got 8% because, I'm sure a lot of 8% is a huge number in 2 weeks, but there are a lot of people who come over to us from the option buying background where an 8% return is, whatever, because sometimes people will be flipping 100, 200, 300% returns overnight with weekly options. But what we know about being an option buyer is that in the long term, you're going to lose money. It might be fun to double or triple your money one time, but in the long run, when your account is taking a quick dive towards the zero price level, that's no fun, and that is not something that we want to be in on. In fact, by being option sellers, we are quite literally on the other side of that. So hopefully we'll see progressively increasing amounts in our account balances, and we have demonstrated that so far over the past year that we've been publicly tracking our performance. But back to the play that we had at hand with Twitter, we rolled them down to 54, we rolled them out to May 14th, and again we're in a position where if it finishes above 54, we're going to make money here. But now the new question is, hey, what's our break-even price? So we're going to put a formula in here. It's going to be max 54 minus the current price, comma 0. So we know right now if Twitter finishes at 53.79, we're going to make $1,100 on the second leg of this trade. $690 profit, that's going to be awesome. But let's try to calculate right here and see what our break-even price is now. So we're going to remember that on April 30th, we've got Sierra pointing out in the Twitch chat that she's in the progressively decreasing account balance club. We are going to get you out of there quick. I think based off what you have shared in some of the plays that I've seen that you've been in on, you could be one of the unluckiest people I have ever seen, even though sometimes I feel like that might apply to myself. Some of what you've been in on has just been brutal in the context of what's been going on in the market, but I believe you've got down what we're doing. I think you're going to be back in no time, so keep your head up. I love the positive attitude you're bringing to the Discord. I feel like the positive attitude, the good energy that we've got going to the Discord is only going to lead to better things for us. We've got Jules listening to audio frequencies that are going to help her manifest money, I guess, and maybe she could share some of those sounds with the rest of us because I think it's been working out for her so far. But we're going to keep the good energy going in the Discord, and we're going to finally, hopefully, for those of you who have been on the losing train lately, get you off that, and I think our luck will eventually turn around as long as we stay safe with these strategies that we've put into play. But getting back into why these strategies are safe, let's calculate our new break-even price on Twitter. I don't have a great way to do this other than manually guessing, so let's check 53.5. Nope, we're still at a gain here at 400. Let's check 53. Now we're at a loss. Let's check 53.10. And there you go. Our new break-even price as of 5/7 when we opened this is now $53.10, meaning that we're going to have to update this to K10. So our break-even price has been reduced 6.86% in 7 days, and a 6.86% move on a big stock like Twitter is pretty sizable, especially off the back end of a huge drop like this. So now our break-even price is 53.10. As long as we stay above that for the next week, we are going to find ourselves in a position where we make money. So let me put the formula back in here to put the actual stock price in here, and as we can see, as it fetches the Twitter closing price on Friday of 53.79, we're in a position where if Twitter trades flat between now and next Friday, we're going to make $1,100 on this leg, putting us at a $690 profit. Nice on this trade overall, despite the fact that it's dropped almost 6% on us. And I promise you, I mean, some of these trades stick around because they moved against us. If we go to our tracking tab, we've got plenty where the stock goes up and it's a lot easier. However, we've been on a terrible run here where we have so many stocks going down. In fact, our median stock return is minus 1.2% and our average stock return is minus 1.5%, which is brutal luck. But with that in mind, we have an 88.14% win rate, which hopefully will just increase over time because we still have plays open like Etsy, like RMO, like Icln, LOTZ, PSTH, where we think or assume we could eventually turn those into winners. So hopefully that win rate is only going to get better. We've got Jules throwing some tickers in the chat that she's looking at for Monday. Let me throw those on my notes sheet and we could loop around to those once I get through the weekly recap that I'm working on. And we're almost there. FCX, GOOS, FL, XOM, ZIM, and NMM. Jules, those are on the list and we are going to talk about those. So, back to, we were talking about the Twitter trade. Our new break-even price is lower. Rolling that out on a week-over-week basis, we're going to be good to go. So, let's talk a little bit about the Peloton trade that we set up really quickly. So, let me get down to the current week really quickly. Or the previous week, excuse me. We sold Peloton May 7th, 70 strike puts for 80 cents, closed them out for 59 cents a piece for a $210 profit. Now, Peloton finished above 70, so this would have been a $800 profit if we closed, but you're never going to go broke by taking a profit. One of the biggest things that we base our strategy around is the idea of stacking small gains on top of each other, one after one after one after one, to create a big gain in the longer run in the bigger picture. So we're perfectly happy to take a little bit of a gain like that off the table when we see it, especially because as we've seen or as we saw last week, things were moving against us quickly. But here is what we did for those of you who didn't quite understand that. We don't have a trade breakout here. But with Peloton, let me pull up the chart. As a lot of you, I'm sure, are aware who keep a finger on the pulse of the market, Peloton had that announcement last week about the recall on their treadmills. But we took a little bit of a look into that. We found out that their treadmill revenue only accounts for 2% of their total revenue. But all in all, even that information off the top is enough confidence for us to say, hey, I think a drop from 98 down to 80 off something that only accounts for 2% of a company's revenue is a little bit overblown, especially right in advance of earnings. One of these setups that I really like ahead of earnings are on stocks that have jumped down a ton. Because when they do that in advance of earnings, a lot of the time it's because it's in anticipation of poor earnings. So if you get to the earnings date and something like this has already happened, it's more likely than not that a drop like this is already pricing in bad earnings. So if the earnings are bad, there really isn't too much further from this point. And we have to zoom out again on the y-axis just to show how much more of a cushion we had. We sold 70 strike puts, which means that, as long as it stayed above this level right here, we'd make max profit. And that is a huge, huge cushion. As you can see, it cruised into Friday at Experian. We sold these back when Peloton was right about here, I think. So we caught this on the down leg, and you might be in a situation where you're saying, okay, you might be catching a little bit of a falling knife. And that is true because we sold these for 80 cents. And when it dropped down to here, I think at one point the price of those went up to $1.60. So if you were someone who bought options, and I could give a shout out to Neo in our YouTube chat because I think he may have misunderstood a little bit what we did off the bat, and he bought the options at 80 cents. So he was the benefactor of it dropping a little bit further and having the price of the option double. But as we know, when we sell options, one, we don't want the price of it to go up because we make money as the price if it goes down. But two, we knew not to panic when we sold it for 80 cents and it went up to $1.60 because at the end of the day, as long as it stayed above this level, that $1.60 was going to quickly turn into a zero, and that's exactly what we saw. So for the same reasons why it's a terrible idea to buy weekly options, because you might have bought this for $1.50, you might have bought a $70 put for $1.50 even though it was trading above 80, and that value would quickly go from $1.50 to zero. For the people who sold you that put, there's no need to panic when it's trading at $1.50 if the stock is up here, because as long as the stock stays above here, and as we saw during earnings, there was a little bit of volatility after hours, but all in all, it comfortably finished above that price target that we initially chose. So everything was going to end up okay. But I think Neo purchased those. He had a really big short-term gain, and in the short term, I mean about like 5 or 10 minutes after we bought those, because we did a terrible job of timing that because the price and the premium shot up very quickly. But for those that bought them, it was great timing. So I hope he was able to take profit on those, because we never recommend buying options. We only want to sell options. So hopefully he took profit on those. But again, if you're a buyer and you got out short term, you won. If you're a seller and you waited long term, you are also a winner. But that is what we did quickly on that Peloton position. And I think that it should round out. We got UXIN. That one's pretty boring. We don't need to talk about that one. And we also got a question about PENN, Penn, the gambling stock. We could also circle around to that one. But yeah, let's get going down the list. I think that pretty much sums up our terrible, terrible week. I think I need to update a few of these prices. So I'm not sure if this is the final count, but we'll have that updated and rolled forward to the following week soon enough. So let's see what's going on right here. Perfect. Okay, that is everything we need to do. We're going to finish this up, not on the stream because it's pretty boring, I think, to watch us update our tracker. So let's jump back into Thinkorswim. Let's get talking about some of these tickers we've got up. The first is FCX, and I know this is a copper one because this is one that we've previously talked about on the stream. For people that were interested in getting in and having a little bit of a stake in a commodity as opposed to a stock. And oh my goodness, it has run up so much since we last talked about it. I think last week it was right in this 38 range, and I was saying that I was hoping for a pullback into the mid to low 30s for a little bit better of an entry, but now this thing is just running away. And I think the idea for us about getting into commodities is there's this fear of inflation in the market, and when that occurs, obviously it could put a little bit of fear into investors, but one of the places that inflation shows itself is in commodities like this, where you see a huge run up, almost a 4x in the price of this copper mining stock. But the thing we love about this one is it's got weekly options and decent premiums, to be honest. Let me bump this number down to 14 so we can actually read what's going on here. And honestly, for something that's run up so much, you only get $1 premium, meaning if you sold a 44 strike, put your break even would be 43. That is not that much cushion on a short-term basis for something that has run up so much. So while this has been something that's been on my watch list and I wanted to be patient and see, hey, can we get a fall back into this area so I could enter? It never happened, and I think I might start to take this one off of my watch list just because of how far and away it has started to run. This can go back a little bit and relate to what happened with Etsy. We really think we need to do a better job at the 180-day chart and evaluating plays in the context of where stock price is historically, not just compared to the last month or two, but maybe even the last half a year to a year. Because if we look at Etsy, right, once this chart is enormous, that's a huge drop. It sliced almost a third of its value from the peak. And I'm really relying on my internet here to load this chart so we can look at it and I don't have to keep talking in circles and buying time while we wait for it to load. However, it is still not loading, so I might need to keep doing that for a couple more. For all the mothers out there, I hope you guys are having a great Mother's Day. For my internet provider, I hope they start doing a little bit better so that this chart can load and I don't have to keep talking like this. To everyone in the chat, once again, this is another great opportunity for me to thank you for tuning in. I can maybe try to pull up a different stock here to see if the chart for that one loads before this happens. Okay, there we go. Got some action here. Okay, the Apple chart loaded. We're going to try the Etsy chart one more time, see if it comes up. Perfect. Let's pull up the 180-day chart. And now I can stop talking in circles and trying to buy time. So we might say that, hey, the drop from 165 is a pretty damn big drop in the context of what's been going on over the last few months with Etsy. But if we look at the 180-day chart, we could say, hey, this 250 is off a high of 130. So really, it's still up 60% in the last 180 days. That's a pretty big number as well. Now, a lot of that is fueled by the increased demand for the industry with the pandemic. And I think we could look at the one-year chart to put this even greater perspective. And once again, maybe I should not have tried my luck here by trying to back up the chart. I think I might have taken the chart they gave me, but here we are again at the beautiful loading screen on that Thinkorswim. Rambling to myself like a maniac in the corner of my bedroom tonight. So analyze, we're going to go over GOOS, because what do we do when we don't know a stock? We are going to look it up using the Analyze tab in Thinkorswim. And normally this is something that has a little bit of a company description here, but we're not seeing it. It tells me that it's in the consumer discretionary industry. So what we can do with that information is pop over to Google when Thinkorswim doesn't answer questions for us. GOOS stock. Canada Goose Holdings, a company of winter clothing manufacturing. Jules, if you have any context on why this is on your list or what you think about this one, any opinions at all, feel free to fire those out into the chat. We can look at this. I mean, thank God these charts are actually loading compared to what's going on Thinkorswim, but it's gone up in the past year from 20 to about 40 where it is. Nothing too crazy. I think one of the issues we run into a lot on these streams is that people hear about stocks and want to see them analyzed because they have a chart that looks like a half pipe or something shooting off to the moon, and that's why it's at the forefront of the attention for social media. But this doesn't seem to be the case with that one, and I think that's a pleasant surprise. So let's pop back over here into the chart. Maybe this one will load. If we type in GOOS. And there we are. Jules says she likes the chart, and I think Jules is a wizard with the chart. She loves the VWAP. She loves the entries. She loves the exits. She's done a very good job, I think, with that. So if Jules is telling me that this is a nice chart, then you better believe I'm going to think this is a nice chart. There was a pretty big candle last week to get it from 40 to 43, so maybe, entry-wise, we like to take a peek at RSI. It's slightly overbought at 60, but let's see what we could do for the premiums to make up for that. Once again, a common theme on our stream tonight, waiting for data, and there it is. Come on, numbers, let's load. Okay, again, what we love about this, weekly options, that's one of the first things I look for. One thing that makes me a little bit hesitant is the lack of volume that we see here. So typically you'll see heavier volume at big round numbers. Like you can see there's pretty much no volume until you hit 40, where there's 21 of those sold, but that's not a ton. Then let me check the return on capital numbers to see if this is one that we could use our buying power privileges for. So normally selling one cash secured put here would cost $4,000. Let's see the buying power effect on this one. And it is 541. So really not bad at all. Decent buying power maintenance requirements. We could further look at that by looking at return on capital, showing that these are 22% return on capital, meaning the amount of money you get divided by the amount of collateral it requires. That's a pretty damn good number, and I might take a peek at these on Monday when the market opens. So let me, again, back out of the chart because we always want to be covered in case something bad happens. So let's go to the 5-day. And I like the 5-day, 5-minute. But it looks like 40 might be a pretty hard level of support, and we could still get 20. They must have, do they have earnings coming up? They've got to have something coming up here. One of the best ways to do that is looking at your watch list. I'm just going to expand this. Go to the bottom. Maybe I expanded it too much. We're going to, Fastly is getting kicked out here. GOOS. We're going to sort these alphabetically. And we will see that GOOS has earnings on May 13th, 2021 before Market Central Time. That makes so much more sense as to why there's some awesome premiums. It's because we're playing earnings. And while that is, I mean, it's not a red flag in the sense that, oh, you shouldn't do this. It's just something to be aware of because you might see the premiums and think, oh, this is great. And then all of a sudden earnings pop up on you and you are, you know, left on the wrong end of a position. But even as we demonstrated with Zillow and Etsy, earnings aren't a death sentence even if the stock moves against you. But I think it is good to throw yourself in a position where you've got a decent level of cushion and a place where you'd be happy holding it long term. So let's, Jules says May 12th. I mean, we've got May 13th right here before market. So really, I mean, there's not a huge difference between May 12th after market and May 13th before the market. So I think it might be splitting hairs with that one. But, you know, long story short, the earnings are this upcoming week. So that's something that's important to keep in mind if you want to play this one. Another one where, look, if you look in the context of the last 180 days, it was at $22 back last August. It is now up at $43. That is pretty much doubled. Last time they had earnings, they shot up from $35 to $43. The time before that, not a lot of movement. And another tool that we like to look at right here, if we go back to the tab, is the earnings feature. So we could type in GOOS because we know Goose has earnings coming up. And we could take a look at historical earnings action. So back in Q4 19, went from 49 to 33. That is a huge drop. Q1 20 stayed from 43 down to about 38. Decent drop. Then there was a drop from 9 to 35. We've got going from 33, pretty much staying at 33. We've got a rise back in Q4 of 20, from $20 a share up to 26. And then we've got, you know, relatively flat movement Q1, relatively flat movement Q2 upon earnings. And then a huge jump Q3 from 35 to 42. And we have some huge action before earnings here, which is always interesting. One of those things where in the back of your mind, you're thinking, hey, does somebody know something? But it's, you know, fun to think about. Never, you shouldn't put too much stake in something like that because that could be guessing a little bit. But definitely based off where the price has been back at the beginning of March, some upside potentially in the $50 area. So maybe something where potentially selling covered calls might look a little bit better off the bat if you wanted to take advantage of some upside. Looks like you could get about $1 going up to about the 46 or 47 level for selling covered calls. But again, that's not too huge of a gain on the shares. I think your best value here is going to be selling puts down in this level. But once you get past 40, these spreads get so wide that I think the return on capital number is not even useless anymore. But I don't really have an opinion on the company. I don't know too much about the company, so I can't speak on that. But from a chart perspective and what we saw with Etsy last week, where the company beat earnings but dropped down to a level that objectively on a week-to-week basis sucked and was a huge drop, but was back to a level where it was still plus 60% over the last 180 days. I think that could be something that happens here. We see a lot of times with companies that are extended like this, and by extended I mean up a ton over the last 180 days or 360 days, that unless they're killing earnings, they're probably going to pull back a little bit. And as we saw at Etsy, even if it did kill earnings, it pulled back a little bit. So this is one I'd be wary of. I mean, the premiums definitely are attractive. The potential to pull a 20% return on capital at a 40 strike in just 1 week's time is a great value proposition for something like this, especially where there's a demonstrated level of support here in this 40 to 39 area. So I don't think that's too bad of an idea. I'm going to stay out on this one just because I don't know too much about the company. I don't really have an opinion on it, but I think the premium is definitely there on the puts. Just I think this setup more than ever, I think it's important to set something up where you're not putting 100% of the capital in the trade here. You might put half here, and then if it goes down, because what I'm worried about is this big gap up from 35 to 40 from the last earnings. I think if there's any bad news and it drops below 40, 35 is almost a guaranteed bet right here. So maybe place a 50%, 60% of the collateral you're comfortable investing into this company in at 40 strike off the bat. And then if it drops down to 35, you're going to have a really, really good entry opportunity with the remainder of that collateral to help lower that break-even price. You probably would be right around a break-even of 35, which is an $8 drop off 43, which is almost 20% of a cushion on this one. So that's something where you could use the concepts of, where support and resistance can be found using the cushion that the premiums offer. But I think that's a decent setup for that. Next stock we're going to talk about is Penn. We're going to pull that one up real quick. The shout out to KB in the YouTube chat for bringing that one up. And this is one that has been crazy fun to watch because, as we've talked about before, if we back up to the 1 year chart, this thing was like $3 a share. We could go back even further to the 3 year. Yeah, $3.75 a share at the very, very bottom, which was right after COVID hit. And if you had bought it at here, you would be sitting on a pretty sizable, maybe 50x gain, it looks like, as it ran up to 150. It's since pulled back to 86, so much better of an entry when we're looking at that. I think anything over 100, I was really hesitant to get in on. I really liked the 60 level back when it was trading around here last year. But let's look in the 180 days RSI. I think this is a great place to look, as always, because it is, I think, the single best indicator of whether something is going to go up or down in the short term. But what we can see right here, it's bounced off 30 a couple times, and more recently bounced off 30 when it bottomed out at 82, which I think was last week maybe because they had earnings. But this is an industry I'm really bullish in for the long term. I think this is a place where there's going to be some serious growth, and one of those things where there is some significant regulation and legislation in that area. But gambling is an area that's only going to become more and more legal. It's not like there are movements to actively suppress the states that currently have legalized gambling. It's one of those things similar to marijuana, where it's only going to get more and more legal and widespread in the United States. So long term, it's an industry that I am bullish in and would like to have my money. The question, though, again, looking at the chart and the scope of 180 days, is if this is a decent entry point, and it has shown some strength in this $50 level. And, I know $50 isn't the most encouraging support when the stock's trading at 80, because that would represent almost a 50% decrease in the stock. But let's take a look at the week-to-week premiums. So we're going to pull up only 14 of these at a time. And from a return on capital perspective, really, really not bad at all. That's a 4% return down at 80, which is a pretty damn big cushion for 1 week's time. But let's look at return on risk, because I think objectively that's the best way to evaluate the return that you're getting on these. 0.56%, you can get 2.86% at the money. But again, this is one where if we look at the last 5 days again, now I had earnings, so this probably isn't representative of how it moves on a week-to-week basis all the time, but it traded in a range between $80 and $93, which is a $13 range for all you math geniuses back at home. And, can you get a $13 cushion here? A $13 cushion would be at 73, where there's basically, not even enough premium to justify selling these on a week-to-week basis. And you might say, yeah, that's just because of earnings, but let's back out to a 20-day, month-long period. Again, these are 20 trading days, so from a calendar month perspective, it's an entire month. It's traded in a range of 80 to 104. So this isn't atypical week-to-week, behavior for this stock. So this is one I'm a little bit scared of. And again, similar to FCX, I've got it on the watch list, but as you can see right there, PENN, not lying about that one. But I'd be much happier getting it at this level. So throw a price alert on it. Wait for it to get back down in this, anything below 70, I think is a green light to start playing it. But I think it could go lower than that. But in the long run, I don't think 86 is the greatest entry of all time. Using RSI is a pretty good indicator because, last time this got blue or severely blue was back on, let's see, what, April 20th when it was at 87. That would have been a good entry because you could have just sold premium between then and now. Stock was dead flat, so you could have just taken 2-3 weeks of premium to the bank on that one. But yeah, RSI, especially on the 180-day level, is a really good indicator. Last time it was also that blue, if you go back to the end of October, was when it was trading in the 57, 58 range. As you can see, it pulled back to 53, but then had to run up to 142. So once again, the RSI was a great indicator of when you should enter into the position. We see a little bit of blue back in January, and that was right before it ran from 80 up to, let's see, what, 105? So I'm going to keep an eye on this. If it drops any further, and if it did drop down to this level in a decently short time frame, I think we would see a similar level of blue. That is when I would be happy to get on this one. But, long-term bullish, short-term, wait and see. I think I can get a better entry. There's so many different stocks out there. There's so many different opportunities, so many different, option chains that offer really impressive amounts of premium that I think it's important not to fall in love with a single stock because there's so many opportunities out there on a day-to-day basis. And I can't tell you how many times something has happened during a trading week where I say to myself, damn, I wish I had some money to put into play right now. It's something, like I mentioned earlier, admittedly, I haven't done the greatest job at conserving capital for when stocks drop. And again, we could talk about this in the scope of the broader market and what we see. I mean, this thing has to be coming down soon. And I'm sure there have been people who are saying that since last October who have gotten their ass handed to them by saying, it's going to drop, it's going to drop, it's going to drop. And then, it runs up nonstop. But we are getting to the point where I think there are some discussions. I think the Janet Yellen alluded to the fact that, we couldn't keep pumping the market forever. She's in a place to influence monetary policy. The Fed's kind of been going crazy. There's no indication that they even need to stop, so it can keep going. Again, Matthew M. made it to the YouTube stream. Shout out. Appreciate you checking in. Always happy to see people throwing stuff into the comments. Happy to have you here. But again, in the scope of what's going on in the market, we had a little bit of a scare. And I say scare because during the day, it's like, oh no, the sky's falling. We dropped from 420 on SPY down to 412, which seemed like a pretty big drop. But I mean, looking at this 180-day chart, that drop is absolutely nothing compared to what we've seen back in the beginning of March, end of January with this drop. And then we could go all the way back to, October when we pulled back from, 350 down to 320 and did the same thing at the beginning of September of last year when we pulled from a peak of 360 back down to 320. So the point is, and I think this is a really important point to make outside just the typical stock analysis that we do, if this, and I'm sure if you've had your eye on the market on a day-to-day basis, you remember this little pullback right here at the beginning of last week. If this caused issues for your portfolio, you might need to reevaluate what you're holding, the amount of leverage you're using, and how risky the plays that you are, how risky the plays you're in on are. Because as we can see, this is not that big of a drop. And if that crushed you, imagine what something like this would do. And this isn't me going way back into the history of the S&P 500 chart saying, oh, there's a huge drop here, there's a huge drop here. Pullbacks and skids like this are incredibly common. It's happened 1, 2, 3, 4, 5, and maybe an extended one, 6, just in the last 180 days. So we are more than due for a decent red candle. And my strategies going forward are, one, to stick to a lot of these earning plays because I could put myself in a position where if a stock drops 30%, I'm still okay. And I think that's a pretty good way to combat a potential market drop. But two, the other thing I'm trying to do is just be a little more patient with my money, wait for days where there's huge red candles to start opening positions and not just open things to open things on Mondays or Fridays just so I can have something for the upcoming week and have all my money in there. But it's important to keep the overall picture in mind because the stock market is largely correlated. Obviously, there's some variances between different industries, sectors, and stocks based off what's going on. But in general, everything is relatively correlated to the overall market. So it's important to keep trends like this in mind. And with that said, we do run that SPX call credit spread hedge most weeks. I'm definitely going to jump back into one of those on Monday because we are back in the red. We could pull back our old buddy RSI. We are back in the red, 71. The last time we were in the red on RSI came on April 15th, which obviously wasn't too long ago. But again, we were in the red up here, and right after that, we went from 417 down to 411. So I'm thinking something's got to give. If we open green Monday, I'm going to go decently heavy into some SPX call spreads. And when I say decently heavy, that doesn't mean I'm putting half my account into them. I might just open, I typically open 10. I might go with 15 here in order to make about $1,500 of profit, provided the market either stays flat, drops, or doesn't go up too much, which is, again, the great part of opening credit spreads like that. So we've FCX, we've talked about that, talked about GOS, we've talked about PENN. Another one that Jules wanted to suggest, and I'll tell you what, Jules, we're going to have to wrap this up soon. So if there's any particular ones between FL, XOM, ZIM, and NNM that you want to talk about, feel free to throw those in the chat, and we could pick one of those out before we wrap it up tonight. And I'm going to take one more sip of my delicious water. One of the things to look at quickly right here is go back and rebuild our option scan to show us the highest premiums in the market. Again, we're going to put this at like 1 or something. We don't want to max. We want it just out of the money. We want things 0 to 7 days to expiry. We're going to take the earnings off. I don't really want this study on here. And instead of searching just within the S&P 500, we're going to look at all symbols here. And here we go. So that is a lot. The one thing that we need to add that we don't have here is a volume filter, because this is showing a bunch of options that have just 0 activity. So we're going to go here. We're going to go down to the V's, and these are alphabetical. I think 20 is a good number to have, because that just shows there's enough for you to be trading. So here we are, some of the biggest returns in the market. Ignore the VXX. These are, I'm not entirely sure. Those are strange contracts. But this is where it gets a little bit more realistic about things you could actually trade. Tilray is offering a 9.98%. These are all, I guess, a May 7th in there. What is that? I guess I should 1 day to expiry and redo the scan. And what do you know? That eliminated most of the weird contracts. We still have some of them in there, but looking like Fubo is the #1 option on the market for premium this upcoming week. And not that that means that is a remotely good idea, because I think that stock is not the best, but where it is right now, we can take a peek at the chart for the hell of it. Trading at 1724, decent entry compared to the 63 that it was previously at, and it just boggles my mind that it was previously up there. But again, let's do something like this. We talk about these setups. Let's zoom in on the chart like this. I think charts like this are something that we pull up so often when we analyze stocks. We're going to say, hey, this thing was at 826, but it's at 45. Premium's good. Should I get in? And why I always want and suggest that people exercise caution is because when we see setups like this, we might say, oh, there's some upside up to 63. Oh, the premium's good, so I could have a break even around 40. But is a break even price of 40 something that you want on a stock that previously, less than 6 months ago was trading just above $8 a share? And I think the answer to that is a resounding no. And as you can see when we go back to the actual chart, more often than not, this is what happens when stocks have some unsubstantiated run-ups. Not unsubstantiated in the sense that there was no news. There was some good news. They have a stake in, I think, some sports gambling streaming markets. But the question you should always be asking yourself is, does that news justify a run from, the price it started at up to the current price? And that's one of the easiest no's I think we've ever seen for a stock like this. But as it comes back down now to 1724 and finds its way to the top of our put scan for a 7.9% return. Are there earnings this week? What's going on with Fubo? There are earnings, and it looks like they're on May 11th. Interesting, because you can sell a 15 strike put and get a 3.13% return on risk. That would normally take $1,500 of collateral. Let's see if there's any enhanced margin privileges on this one. Yeah, it looks like you get about half of that, so it'll only take 600 of buying power as opposed to 15 to give you a return on capital of, 30%. Not too bad. I don't think that's entirely quite right, because if you're only making 40 bucks on $600 of collateral, that's not that much. I think it's probably using a different denominator, because that's really only a 7.5% return if you're getting 40 bucks on 600. But, it seems to think it's offering more margin than it is. But anyways, you don't need to hear me ramble about that. If you were wanting to sell something fully cash secured, not the worst idea in the world to try to scoop up, try to hit ROR here, 3% return in a week on something that offers a really nice downside cushion of over 10%, because it'd have to drop almost $3 for you to lose money on this. Not too bad of a proposition right there at all, despite the fact that I think Fubo is a garbage stock. But sometimes it can be fun to chase premium. RSI indicates this is probably a really good entry. So even though I don't like the stock, and sometimes I like to caution people to say, hey, just because something is at the top of our put scan doesn't mean it's a good investment. When we take all these numbers into account, that's not the worst value in the world, because when you get the 15 strike put that you sell to give you like a 1450 break even, that 1450 break even is right around here where you could start to run into a little bit of support. And while you might have it break below that momentarily and you'll be losing money for the first week or two that you're in the trade, you could do exactly what we did on things like Zillow and like what we saw with Etsy. But, not the worst place to be in. You could use that to your advantage if you wanted to set up a play like this. Let's pop back to the scan real quick, just see if there's some other names we want to look at really quickly before we wrap up this this stream. So going down the list, JMIA, that's actually one that we entered a position on because the premium was really nice. We sold this exact put, the 26 strike put. So we might not need to shit on our list too hard here, because we're taking the number 2 name off it. I didn't realize it was the number 2 name at the time that I did that. But let's throw the chart up here to show you what I'm looking at. Great entry. One of those things that was at 688, not the best. But what happened that made me want to jump in on this trade? There we go. Citron's Andrew left sees Jmia heading to $60 by the end of 2021. He thinks it might be a merger target. He thinks it's going to get bought, which, not the worst thing in the world. Anytime there's relatively positive press off something, especially that's coming off highs of about $70 a share, not too bad of a setup, especially when we flip over the options chain here, and you can see it with the little red position flag here that we have sold some of these. But we got about, I forgot exactly how much we got on it. I think 250 is what we got. So we're sitting at a decent profit already. But 250 on a 26 strike put on a week-to-week basis on something. Let's see, do they have earnings this week? They do have earnings this week. But that's really decent premium, because it could go all the way down to $23.50 with that $2.50 credit that we got. And we're still going to be making money overall on the trade. Now, this might be one that we want to ditch before earnings, just because, hey, we're sitting on a little bit of a profit. I honestly am now realizing that they have earnings next week. Sometimes it's a good idea to make plays in the moment, do your research after, because if you identify good premium and a good setup, that might not be there forever, but you could take an hour or so afterwards to look up what's going on with the stock to be more comfortable with the trade. And as you can see, we just found out right now that they have earnings this upcoming week. But, with that in mind, I might close it out with the small profit that we are sitting on, just to free up some more buying power for the upcoming week. But at the same time, we identified an opportunity with good premium where we sold for $250, and I can flip back to the profit tracker to put some actual numbers behind what we're doing here. But come on. Come on. Please load. I think I made a tab for it. I did. Yeah, there it is. So again, we got into the trade with JMIA, and hopefully this will load so that as I speak, the numbers are on your screen. It was trading at 26.20. We sold it for 250. It's down to 185 right now as we saw off that option chain. So we've currently made, if it does the calculation at any point here, we've made $325, which is a 5.5% return on capital, since we only required 5,800 of collateral for this one. And if we were to cut this off and, close it tomorrow on 510, That's an absurd annualized return. For us to pull 5.5% on a trade in 4 days. Sometimes these annualized returns get pretty funny because obviously you're not going to do this every single day. But again, this is to help put into context how impressive of a gain that is in that short of a time period, and how if you kept doing this time after time after time for a whole year, you'd have an insane gain. But back to the point. Let's see, sold puts after earning. This is an old note. Anyways, the point here is that, look, we've already got 325 of profit. We know that there's earnings coming up. We got into the trade at the time because we liked the premium. We said, hey, the 250 premium looks really good right now. It might not be there forever. And that is demonstrated by the fact that it dropped below $2 within, a day of us opening the trade. So that hammers home the idea that while the premium might not always be there, sometimes if you identify good premium on a decent chart and see something that seems like a good opportunity, it's not a bad idea to just pull the trigger now and do the research later. So we pulled the trigger. We were familiar a little bit with the stock, so it's not like we just completely blindly went into this thing. And I think we typed 27 in here, but we actually sold 26. Maybe we did sell 20. No, we definitely sold 26. We sold just out of the money. So we sold 26. That was a typo right there. But the idea is we got in because the 250 premium didn't seem like it'd be there forever, especially when you're selling these weekly options. It evaporates so quickly on a day-to-day and even hour-to-hour basis sometimes. So we got in, took advantage of the play. It has since dropped a decent amount, and now we're in a position Monday morning where if this price holds, we could, pull it out for a 5.5% return, lock in what would be almost a 15,000% annualized gain, and not even have to worry about the risk of earnings. We could take this capital, move it into something else, and keep the line moving. So that's the idea behind, jumping in on trades when you see good opportunities like that and good premiums and good setups on the chart. But with that said, that's all in all a recap of what we did last week. We took a look at some other tickers. Here's what we've got set up for this upcoming week. Let me show you this one now. We've still got our UWMC position, and this is one where, this thing closed at 696 last Friday. You could put yourself in a really, really good position here. If you don't have a position in UWMC currently, and take this with a grain of salt potentially, because I've also said this when it was at $8 and $9 and $10 a share. But I don't think there is a better time to get in on UWMC because I believe they have earnings this upcoming week. May 10th after market, which is tomorrow afternoon. They've had some really, really solid growth. They pulled back this past week from 8 down to just under 7 off weakness from Rocket Mortgage's earnings. As you can see, these red candles correspond with Rocket Mortgage. We could actually pull that chart up so you could see. They reported earnings, had some decent red candles, and UWMC pretty much mirrored that. So a lot of this leads me to believe, and we talked about this a little bit earlier with some of these setups pre-earnings where, hey, like with, it wasn't with Twitter, but I forgot which one it was off the top of my head. It's getting late. Cut me some slack here. But like we were talking about, if you see some action below where the stock is moving down pretty sharply into earnings, and that's exactly what we see with UWMC, what this could be interpreted as is the market pricing in bad earnings because Rocket Mortgage didn't have the greatest earnings. It dropped. So in a sympathy move with that, UWMC also dropped because people are assuming the earnings won't be so great. So what does that mean? If we announce earnings Monday afternoon for UWMC and they're bad, well, guess what? The market has kind of already priced that in. So it seems to me at this level for UWMC, especially with their upcoming earnings, there's a lot more upside than downside at this point for the setup that we currently have. And that's, we always like to talk about risk and being cognizant of your downside potential on a trade. That's potentially what we see if there's bad earnings. If there's bad earnings, it maybe is priced in at this point. Again, everything's a maybe when you're analyzing the market. If we knew exactly what was going to happen, we would be rich because we would just, sell options exactly at the strike that we knew the stock was going to go to. But no one on earth knows what the market is going to do. So it's important to be mindful of that downside risk. But even better, let's say they blow out earnings, and this is what I think is going to happen because they're a strong business and the housing market has been insane lately. We could see some serious upside back up to this $8 level, and I'm hoping eventually in the context of the trade that I have open that we revisit the $9 level at some point so I can have these puts I sold expire worthless. But good earnings could see a really nice rebound up to 8, but point being where it is right now, closing at 696 on Friday. after what could be bad earnings already priced in, so you really don't have too much further downside from here. You could take a look at the options chain. If it'll load. Once again, another common theme of our night so far. Hopefully that'll load. Come on. It's not happening. But anyways, I think you could still get about, what do we have? 17 cents for a 9-strike call, which would mean your basis would be $6.96 minus 0.17 to get you at about a $6.80 basis with a potential upside to $7.50, which would be a 70-cent gain per share on shares that you have a 680 basis on. So that'd be 0.7 divided by 6.8 would be a 6.8, not 6/8. Nice job. That'd be a 10.2% return in just 2 weeks on a stock like that if it runs back up to 7.5, which I think there's a decent chance of it happening. PSTH, we're hanging tight, locked and loaded on that one for a deal announcement. And until that happens, we are going to keep selling calls on a week or 2 week by week basis. LOTZ, talked about that one again earlier. We're perfectly happy to keep this one riding. Not sure what these actually closed at. Here we go. We can actually put a number behind it. The 7.5 strike calls for UWMC are trading at 35 cents as of close on Friday. That is so much for a stock that's trading at 6.96. That gets you down to almost a 6.50 basis, which it has never traded at. So awesome value there. LOTZ, I'm not sure if these are still trading at $1. But if they are, I think that's also some awesome value. We might have to wait a little bit for that one to load as well. But if those are trading at $1 still, that's a great place for us to be at. We're also rolling with Icln. I probably wouldn't get on that one. That's pretty boring. STON, we've got this one rolling. It's in max profit position where hopefully we're going to get these shares called away for $2.50 a pop come May 21st. NNDM, like we talked about earlier, we're going to keep that one rolling. Same with RMO. We're in Etsy again as part 2 of this trade to help save it. That's part 2 of the Twitter trade where we rolled those down and out. This is part 2 of the Zillow trade where we rolled them down and out and additionally opened some more because we like the stock so much. The JMIA one we just talked about where they are 26 strike puts where it's already down to about $1.77. We made some decent cash on that. And then UXI hopefully will expire worthless because it's way above $1 and we're just going to collect $300. The only thing we have to do is just wait. And then Clover Health, we messed up a bit on that one because it's pulled back to the $8.50 range, but hopefully, even if it sits there, that'll pull back to about 50 cents a pop. This is one maybe I wouldn't recommend getting in on if you don't have a position, but the rest of these, I think, especially UWMC, decent entry. Hopefully, LOTZ is loaded. There we go. We got about 90 cents a premium on that, where it's going to be 30 cents a premium if it expires where it currently finished aftermarket on Friday. So that's really decent value. If it runs back up to 7.5, that's a 14% ROR in 2 weeks, which is phenomenal. But with all that in mind, that is going to wrap up the stream for tonight. We did our weekly recap, and it was not a great recap because we got our ass kicked. But hopefully a week from today, I am going to be talking to you guys, and it's going to be a much better number here. Recovery for the month of May. But we're going to have to see how it all plays out. The only thing that I'm really thinking about adding that we've had for the previous weeks is a hedge, as indicated in orange here, of an SPX call spread. Might just kind of arbitrarily pick those numbers where I get a decent 1-to-3 reward to risk ratio. But that's the only thing I'm really going to be looking to enter. I think the name of the game, especially with what we talked about, the S&P 500 in the context of what's going on lately in the broader market, the name of the game right now is going to be freeing up your buying power so that, I mean, it's inevitable the market is going to dip. Whether it runs up to, 10% higher before it dips, whatever, we know a dip is going to come. And if it does come, we want to be ready with cash on the sidelines to take advantage of it and sell some puts with inflated premiums. So name of the game this week is going to be to free up buying power, hopefully get out of Etsy and Zillow and Twitter with a profit. That would be a huge victory for us. If UWMC earned RMO after dropping $1 last week on us, would get us back in the winner's circle on this one. But again, we're letting stuff ride. I'm not going to look to add too many more positions to what we already currently have, but rather look for, calculated exits. For example, JMIA, I might try to get out of this one to pocket that $300 of profit really quickly and then keep that cash on the sideline for the dip. But I don't really know what else I could say other than be prepared, because if it's going to come, it's always going to happen. There are never not going to be dips in the market, so be ready for when it happens. ready for when it happens. We're going to be in the Discord talking about it when it does happen and keep you guys posted with our trades as we make them in the Discord server to let you know when we are freeing up capital in case you want to join that endeavor. But again, that we're going to wrap up on that note. Thank you to everyone who tuned in tonight, either on the Twitch or the YouTube side. Always appreciate when the comments come in, and we are going to sign off the way we do with all of our videos, saying thank you for watching. This has been the Hourglass Passes. We make money. See you guys next week.